Look at the number in your bank account, not the cash in your wallet. The number on the screen. The paycheck that landed there Friday. The rent that left on the 1st. The car payment. The streaming charge. The transfer to savings you keep meaning to grow. Every dollar of it is just a figure on a screen sliding between other figures on other screens, and you trust that it's real without ever once asking where it came from. Here's the obvious part. You know your bank doesn't keep your money in a drawer with your name taped to it. You know it lends your deposits out. Your savings quietly become someone else's mortgage. Everyone learns that much. That's obvious. What's less obvious, what almost nobody is ever told, is that most of the money in your account was never anyone's savings to begin with. No one earned it, set it aside, and handed it over for the bank to lend. The bank made it. Out of nothing. By typing. Banks don't pass around a fixed pile of money that already exists. They manufacture new money at the exact moment they make a loan. And once you understand that, money stops being a noun, a thing, a quantity sitting somewhere, and starts being a verb, something that is constantly being done, created, and destroyed all around you, mostly by private companies you were never taught to question. Start with the version they teach you, because it isn't wrong, exactly. It's just the tutorial. You put $1,000 in the bank. The bank holds a fraction in reserve, say 10%, and lends the other 900 out. That 900 gets spent and lands in another bank, which holds its 10% and lends out 810. Down the chain it goes, each bank keeping a sliver and passing the rest along until that single original 1,000 is quietly supporting many thousands of dollars in loans across the whole system. Economists call it the money multiplier. It's clean, it's elegant, and the first time someone walks you through it, something clicks. You finally have a word for a thing you'd only ever felt the vague shape of, the sense that banks were doing something with your money that you didn't have language for. Now you do. But hold on, because that tidy little model has the whole thing running backwards. Here's where the tutorial meets the real world, and the real world pushes back hard. In that story, the deposit comes first, and the loan comes second. Money goes in. Loans come out. That is not how a bank actually makes a loan. When a bank approves your mortgage, it does not go rummaging for some saver's deposit to hand you. It opens your account and types the number in. The $200,000 on the other end of your loan did not exist the instant before you signed. Your promise to repay is what called it into being. This isn't a fringe idea whispered by cranks. The Bank of England, an actual central bank, spelled it out in plain language in a 2014 paper. In the modern economy, the overwhelming majority of money is created by commercial banks making loans. Loans create deposits, not the other way around. The saver is not the source. The borrower is. Look at what happens on the bank's own books the instant it lends. It writes down two new numbers in the same keystroke. On one side, your loan. That's an asset to the bank because you now owe it and you'll pay it back with interest. On the other side, your deposit. That's a liability because the bank now owes that money to you. Both entries appear at once, balanced against each other, conjured together. The bank didn't shuttle money from one place to another. It stretched its own balance sheet, and in doing so, it stretched the money supply of the entire country by the exact size of your loan. Multiply that by every loan written every day, and you start to see the real engine. And that reserve requirement, the 10% that made the multiplier work so neatly? In the United States, it's gone. In March of 2020, the Federal Reserve cut reserve requirements to zero, not lowered, zero. Banks in America are no longer required to hold any fraction of deposits against the money they create. The clean multiplier you just learned describes a break that, in its textbook form, no longer even exists. So the model isn't just running backwards. Its central assumption has been quietly removed from the machine. So if reserves aren't the thing holding banks back, what is? Because something has to be. Banks obviously can't conjure infinite money. And here's where it stops being trivia and starts touching your actual life. What limits a bank isn't a vault of cash. It's three things: whether it can find borrowers who will actually pay it back, whether those loans turn a profit, and whether the bank holds enough capital, its own money, its shareholders' stake, to absorb the losses when some of those loans inevitably go bad. Money creation is throttled by the hunt for trustworthy borrowers and by the rules about how thin a bank is allowed to stretch its own skin in the game. That's the real governor, not a pile of reserves, a judgment call about risk made over and over millions of times a day. And notice how little of its own money the bank is actually putting at stake. For every dollar of its shareholders' capital, a bank might create and lend out more than 10. That's the real lever, not deposits, but leverage. How many dollars of other people's promises a bank can stack on top of a thin sliver of its own. Regulators cap how far that can go, because the thinner the sliver, the more spectacular the collapse when enough loans go bad at once. But right up to that cap, the pressure runs in exactly one direction. Lend more, create more, stack the tower a little higher. Now, watch what that does to you. When banks are confident, when borrowers look safe and lending looks profitable, they create money freely. New loans, new deposits, more money chasing the same houses, cars, businesses, and stocks. Prices climb, credit flows. A mortgage is easy to land and cheap to carry. When banks turn cautious and pull back, money doesn't merely stop growing, it actively shrinks. Because every time a loan gets repaid and no new loan replaces it, that money simply vanishes. The deposit that was conjured when the loan was made disappears when the loan is paid off. Money is destroyed just as casually as it's created. It flickers in and out of existence on the strength of a promise. So the ease of getting that mortgage, the rate on your car loan, whether your small business can open a line of credit, even how far your paycheck stretches at the store. None of it is set by how much money exists as though there were some fixed amount out there. It's set by the collective appetite of private banks to create more of it or less. Your entire financial life rides on a money supply that a handful of institutions expand and contract based on how the lending looks to them that quarter. You don't get a vote in that. You live downstream of it. And this is exactly where the people who understand this quietly pull ahead of the people who don't. Most people treat money as a fixed thing they compete over, a pile in the world, and the whole game is grabbing a bigger slice of it. If you sat through the episode on incentives, you already know the pattern. In any system, whoever understands what the players are actually rewarded for tends to move first and move well. A bank's reward here is brutally simple. It profits by creating money and lending it at interest. That's the incentive, and it acts on it relentlessly, all day, every day. So who ends up ahead? The people positioned closest to the moment of creation. Someone who can borrow freshly made money to buy an asset, a house, a business, a stake in something that grows, gets that money first, before the new lending has fully worked its way into prices. They're not breaking the rules, they're playing the actual mechanic, while everyone else grinds away at the one they were shown in the tutorial. At the other end sits the person with cash in a savings account. Their money isn't being created, it's just sitting there, quietly diluted every single time the banks create more. Picture two people in the same year. One borrows freshly made money to buy a house or a stake in a business that grows. Real, finite things. The other diligently stacks the same kind of money in a savings account, doing everything the responsible-sounding advice ever told them to do. As the banks keep creating money, the price of the house and the business drifts upward, and the borrower is sitting on the assets while the saver is sitting on the currency those assets are now priced in. The borrower rode the money creation up. The saver got quietly taxed by it, and no line item for that tax ever appeared on any statement they'll ever see. One of them played the actual mechanic. The other played the one they were handed. And most of the time, neither of them understands that this is the game being run on them. Now pull all the way back and look at the whole structure, because it's far more deliberate than it looks from inside it. You've got commercial banks doing the actual money creation, one loan at a time. Above them sits the central bank, setting the price of borrowing and standing ready to lend to the banks themselves when they run short, the lender of last resort. And underneath the entire thing sits a backstop most people never think about until the moment they'd need it. Consider what the system looks like without that backstop. If money is created by banks and your deposit is really just the bank's promise to pay you, then the whole arrangement runs on confidence and nothing else. The bank does not have everyone's money sitting in a vault. It never did in any version of the story. So, if enough depositors show up at once demanding their cash, the bank simply cannot pay. That's a bank run. And in the decades before it was solved, it was routine. In the years around the Great Depression, more than a third of American banks failed. A lot of them destroyed by exactly this: panic feeding on panic, perfectly healthy banks collapsing for no reason other than that people feared they might. And the cruel twist is that running was the rational move for each person as an individual. If you suspect the bank might not be able to pay everyone, the smart play is to get there first before the cash runs out. But everyone reasoning that way at the same time is precisely what empties the bank and turns the fear into fact. Individually sensible, collectively catastrophic. A system that could tip itself over just because enough people quietly agreed it might. The fix arrived in 1933. Deposit insurance, the FDIC. The government guaranteed deposits up to a limit which today stands at $250,000 per depositor per bank. And here's the genuinely elegant part of the design. The guarantee works mostly by never having to be used. Once people know their money is protected, they stop running. The panic that would have torn the bank apart never even starts. Since the FDIC was created, no depositor has ever lost a single cent of insured money. It's a piece of system architecture that stops one failure from cascading into all of them, and it works precisely because everybody believes it will. That's the scaffolding holding the whole thing upright. And when it seized, as it did in 2008, when banks stopped trusting one another's promises and the creation of new money nearly ground to a halt, you got a very clear look at how much of your ordinary life quietly depends on this machinery humming along. Credit froze. Lending stalled. The engine that creates money out of promises coughed and nearly died, and every household in the country felt the tremor, whether they understood the cause or not. So here's the map you couldn't quite assemble before. Money is not a fixed quantity the government prints and rations out. It is mostly created by private banks out of nothing every time they make a loan, and quietly destroyed every time a loan is repaid. Its total size swells and contracts with the confidence of those banks. A central bank steers the price of it. Deposit insurance keeps the confidence underneath it from collapsing. And you, your paycheck, your savings, the rate you're quoted on a loan, live entirely inside this system, whether or not anyone ever bothered to explain it to you. You started this episode thinking money was a thing you have. You're ending it understanding money as a thing that's continuously done, and knowing roughly whose hands are on the levers. If pulling a system apart like this, all the way down to the mechanism actually running underneath it, is the kind of thing you want more of, that's the entire point of this channel. 8-bit economics strips complicated financial systems down to their core mechanics. No hype, no predictions, nobody telling you what's about to happen next, just the underlying code of how money really moves. This is episode 4 of 5 in our Economics 101 series. If it changed the way you look at the number in your account, subscribe, hit like, and tell me down in the comments what you thought money was before you watched this. Because by the time everyone sees it coming, the smart play is already over. So the next time your paycheck lands and the balance ticks up, remember what you're actually looking at. Not a slice of some fixed pile that got moved into your name, a promise created by a bank that will exist for exactly as long as the system's confidence in it holds, and not 1 second longer. Money was never the solid, settled thing you were told it was. It's an agreement, written and unwritten millions of times a day, and now you know who's holding the pen.